My name is Elaine Hession and I work on the policy team within the registry. This evening I'm going to provide an overview to you all of the review of the lending framework which we undertook during 2018. This has been a key piece of work for us in the registry this year. My presentation is going to cover the following areas. I'll provide some background on the review undertaken and I'll outline for you the objectives of the review for us. I'll also provide an overview of the current lending framework for credit unions and some recent observed lending trends based on analysis of prudential return data. I'll then discuss the questionnaire that we issued to credit unions in April of this year and provide some high-level results from data analysis of questionnaire responses. I'll then outline for you the next steps in the process of this review and outline some useful resources that you may find useful for your credit union when considering engaging in new areas of lending. So some background to the review. In order to ensure that the lending regulations for credit unions remain appropriate, we undertook to review the lending framework in 2018. So just to go back to the background in our review, it's been informed by a number of areas. The first one being sector engagements on business model development and longer term lending. Discussion for a number of credit unions has turned towards the provision of mortgages. We also received a formal request from the CUAC Implementation Group in November 2017 for us to undertake a review of the Section 35 lending limits. In undertaking our review, we also looked at recent lending trends across the sector and the current regulatory framework for lending. We also examined the domestic consumer credit market and credit union market share of that market. We considered some broader areas, including asset and liability management, and the information which we gathered from the questionnaire has been invaluable in informing the review for us. Our overall objective for the review is to ensure that there's an appropriate lending framework in place that facilitates prudent growth in loan-to-asset ratios, that facilitates development of balanced loan portfolios to underpin sustainable income generation. Our aim is to also have a lending framework that ensures the appropriate management of duration and concentration risk in loan books, and that appropriately considers other areas such as asset and liability management. The current lending framework for credit unions, as you're aware, is contained in the 2016 regulations, which commenced on the 1st of January 2016. This framework provides that credit unions can engage in 5 main categories of lending, namely personal loans, commercial loans, house loans, community loans, and loans to other credit unions. The framework also contains concentration limits, which place an overall cap on the percentage of lending which may be undertaken in certain loan categories. The concentration limits are currently set as a percentage of regulatory reserves and relate to lending in commercial loans, community loans, and loans to other credit unions categories. The lending framework also contains lending maturity limits, which limit the overall percentage of lending which may be outstanding for periods of greater than 5 and greater than 10 years. These limits currently prescribe that no more than 30% of credit union loan books may be outstanding for greater than 5 years, and that no more than 10% of loan books may be outstanding for periods of greater than 10 years. These percentage limits may be increased to 40% and 15% respectively, where approval is sought from the central bank. In order to apply for approval, an application form should be submitted to the registry along with an accompanying business case, which clearly articulates the rationale for the credit union in seeking an increase in the lending limits. The application form and some guidance around completing the application form is contained on our website. There are currently 15 credit unions who are approved to avail of the increased longer-term lending limits, and we also have a number of applications in progress at the moment. At a sector level, the limits provide that up to 1.4 billion of overall lending may be for a period of greater than 5 years, and that close to £500 million of loans may be outstanding for a period of greater than 10 years. My next couple of slides will just touch on some key lending trends which we observed from analysis of PR data over the last 5 years. So as many of you in the room will be aware, the loan-to-asset ratio of the sector is at an all-time low, on average at around 27%. The loan-to-asset ratio, however, does vary significantly across various credit unions, and there are currently a number of credit unions, 79 credit unions have an LTA above 30%, with around 120 credit unions having an LTA below 25%. So we view that lending is core to credit union business, and that an increase in lending is really what the credit union sector needs in order to ensure viability and sustainability into the future. As part of our review, we also undertook some analysis on the domestic credit market in Ireland. And what we identified from that analysis was that credit unions have managed to maintain, on average, a 34% share of the consumer credit market over the last 5 years. The lending maturity limits contained in the framework, as I said, currently place a limit on the amount of loans outstanding for greater than 5 and greater than 10 years. There's currently 12.9% on average loans outstanding for periods of greater than 5 years and 2.1% outstanding for greater than 10 years. So on the face of it, it would appear that there is significant capacity at a sector level for credit unions to engage in more longer term lending. However, we would acknowledge that there are a number of credit unions operating at close to the limits that provided in the framework, and that there are also a number of credit unions who are reluctant to make the investments required to increase their longer term lending on the basis that the scope provided by the limits wouldn't be sufficient enough to warrant that upfront investment. So the table included on this slide just gives some profile of the lending maturities across credit unions of different asset sizes. So as you can see, the credit unions with assets of greater than 100 million have a higher proportion of their lending outstanding over longer maturities. I'll move now to the lending questionnaire, which we issued in April this year. This questionnaire, really, the purpose of it was to help inform our review, and it sought from credit unions some additional information that we didn't have to hand on the current and the forecasted lending and savings planned for the credit union. Credit unions were afforded a 1-month turnaround time within which to complete the questionnaire, and we were really, really encouraged by the high level of responses that we received to the questionnaire, and I'd just like to thank all credit unions who took the time to complete and submit the questionnaire to us. So for those who aren't that familiar with the questionnaire, this slide just provides a bit of an overview of what we actually requested credit unions to tell us. So questions 1 to 5 sought additional information on the current lending and savings in the credit union. And this was to really supplement information that was available to us from prudential return data. Question 6 asked if credit unions considered if the lending limits contained in the framework were sufficient to meet the forecasted loan demand of the credit union out as far as 30 September 2022. Where a credit union answered no to question 6, they were then requested to complete questions 7 to 10. So where they didn't deem that the limits were sufficient to meet their forecasted lending demand, we requested a breakdown of their forecasted lending demand split across the forecasted lending categories and lending maturities to really provide us with some insight into the forecasted activity across the sector and how that might help us in reviewing the lending framework. Question 11 provided respondents with an opportunity to make some general comments on longer term lending across the sector. So as I said, we were hugely encouraged by the high response rate that we received. In total, we had 181 credit unions submitting responses to us. A very small number of responses had to be omitted from our data sample, so 9 credit unions were omitted on the basis that some of the data provided in those responses just wasn't consistent and it may have resulted in inaccuracies in the data provided to us. So we had 172 credit unions in the data sample for our analysis purposes, and this provided around 65% coverage in terms of number of credit unions and 81% coverage in terms of overall sector assets. So in our view, a really representative sample across a broad number and a broad type of credit unions. It's interesting to note that around 90% of larger credit unions, so those with assets of greater than 100 million, chose to submit a response to the questionnaire. With regards to question 6 and whether or not the limits provided in the framework are sufficient to meet the forecasted loan demand out to 2022, 63 credit unions answered that they did not deem the limits to be sufficient. And 37 of these credit unions, again, were larger credit unions with assets greater than 100 million. 116 credit unions provided some additional commentary to question 11. And I'll touch on some of the commentaries provided later on in the presentation. The next couple of slides I have will just present at a high level some of the results that we identified through data analysis of the questionnaire responses. So this information was really helpful to us and really supplemented the information that we had gathered from PR data analysis. So we knew from the PR that in and around 96% of credit union lending is in the personal lending category, but we didn't have visibility on the types of lending within that category. So what this survey actually told us was that close to 30% of personal lending is advanced for the purposes of car loans, and around 28% of personal lending is advanced for the purposes of home improvement loans, with a much smaller proportion, 3.5% of personal lending for education loans. The maturity profile of the personal loan category, again, we never had previously any idea of the maturity profile of various categories of lending, so this was really useful information for us to gather. On average, around 88% of personal lending is outstanding for maturities of less than 5 years. So this isn't really a surprising statistic for us, and I think it really reflects good credit practice that your loan maturity should really reflect the loan purpose. With regards to house lending, 75 questionnaire respondents currently engage in house lending, with the total value of house loans reported in the questionnaire of 148 million. Now, the level to which these credit unions engage in house lending did differ quite significantly, with some credit unions having 2 or 3 house loans outstanding and others having maybe 70 or 100 or 150 loans outstanding. So that was one thing that we gathered from the questionnaire. The average value of house loans is in and around 66,000. And the maturity profile of house loans, again, it wasn't a massive surprise, but there's around 53% of house loans outstanding over 10 years. Again, as you would expect, mortgage lending or house loans will most likely have a longer term. With regards to commercial lending, 93 questionnaire respondents currently engage in commercial lending. And similar to the trends identified in the house lending, the degree to which the questionnaire respondents engage in commercial lending does differ quite significantly. There was 64 million of commercial loans reported through this questionnaire, and the average value of commercial loans is in and around 16,000. The maturity profile of commercial loans differs quite significantly to that of personal loans and that of house loans, and it's split really between the 3 maturity categories. So you're lending less than 5, you're 5 to 10 year, and you're greater than 10 year. So around 7% is maturing greater than 10 years, and about 32% of commercial loans are within the 5 to 10 year maturity category. The next slide provides some useful information and information I personally found quite interesting, and data we hadn't got previously available to us. It presents the stratification of lending and savings across members by age profile of the member. So what we can see is that there's around 72% of sector loans outstanding to members aged 55 or less, and around 50% of credit union savings are held by members aged 55 or more. The next 3 or 4 slides that I'm going to cover are going to provide at a very high level the data analysis based on the forecasted data provided by those 63 credit unions who answered no to question 6. So these credit unions have an LTA, so a loan to asset ratio, which is broadly in line with that of the sector average of in and around 27%. The forecasted loan to asset ratio for these credit unions is forecast to increase incrementally on a year-by-year basis, whereby 30 September 2022, it's forecast to end at an average of about 34.2%. So These figures presented are averages, so there were definitely variations, within each individual credit union. And the graph contained on this slide actually provides the loan-to-asset ratio forecasts by credit unions of varying asset size. So your credit unions less than 40 million, those 40 to 100 million, and those greater than 100 million. The current maturity profile of lending for these 63 credit unions differs quite significantly to that of the sector average. So if you recall earlier, I said that there's 12.9 and 2.1% of lending outstanding for greater than 5 and greater than 10 years respectively. These credit unions actually currently have 19.2% of their lending outstanding for greater than 5 years and 4.6% outstanding for greater than 10 years. And these credit unions forecast that the maturity profile is to again increase incrementally year on year, where they forecast that at the end of the forecast period that there'll be 31.6% of lending outstanding for greater than 5 years and 11.4% of lending outstanding for greater than 10 years. So when you see the next couple of slides, I suppose that gives a bit more context to how we feel the maturity profile is likely to shift. The table presented just presents the likely maturity of loan books expressed as a percentage of forecasted loans and forecasted assets, again for credit unions of varying asset size. So with regard to the composition of loan books, these 63 credit unions currently have around 2.3 billion of loans outstanding. And over the next 4 years, they forecast that the loan books will end up at around 3.5 billion. Now, the composition of the loan book is forecast to change quite significantly. So at the moment, there's around 4.5% on average of these loans books exposed to house loans. And this is forecast to change to 10.8% by the end of September 2022. Similarly, within the commercial lending space, we've seen a shift in terms of the level of exposure within the commercial loan category. So there's currently 2.9% of loan books on average exposed to commercial loans, forecast to increase to 5.6%. So I think when this is considered in the context of the previous slide, the house loan and the commercial loan categories appear to be those type of lending that are likely to have longer maturities, that a shift in the categories of lending from less personal lending into more house and more commercial lending will ultimately result in longer maturities in credit union loan books. This is again illustrated on this slide, just at a very high level. As I said earlier, for example, the total amount of house loans outstanding for periods of greater than 10 years presently, based on the data analysis that we received in question 1 to 5, is 53%. And that's forecast to change to 73% over the next 4 years. Similarly, within the commercial lending space, I think my figure earlier said there's about 31% of commercial loans maturing in the 5 to 10 year category. And again, as you'll see from this slide, that's forecast to shift to 41% by September 2022. With regard to the funding profile of credit unions, there's no significant change forecast from the 63 survey respondents. So for those 63 credit unions, there's currently around 98% of funding available on demand. This is forecast to decrease very slightly to 94%. So I think the message there is that the majority of credit union funding is still viewed that it will be on demand by September 2022. As I said earlier, 116 credit unions chose to provide a response to the commentary within question 11. Now, the responses provided were broad-ranging and quite diverse. Some related to the circumstances of individual credit unions, where some credit unions chose this as an opportunity to provide a commentary on lending across the sector as a whole. So I have some extracts from these commentaries on this slide. And I don't propose going through them all, but as we said earlier, the slides will be circulated, so these will be available for everyone to see. So you can see there, one credit union said that increased lending limits would enable the credit union to have a greater portfolio mix in terms of scale of loans and maturity levels. Another credit union said, based on the forecast completed out to year 2022, the lending limits as per regulations 2016 should be sufficient for this credit union. Another credit union chose to provide some commentary on the general operating environment for credit union lending. And they commented that credit unions are operating in a competitive and challenging marketplace and not always on a level playing field with other financial institutions. It is imperative that credit unions offer a suite of products that are reflective of members' needs and form a broad, diversified and balanced loan portfolio. Another credit union took the opportunity to comment that the longer-term lending limits should be based on a percentage of asset size rather than loan book size. So as you can see, some very broad-ranging views there, and it was really helpful for us in reviewing the credit union responses and putting some of the figures into context also with the commentary provided. So before I come to the end of my presentation, I'm just going to outline what our planned next steps are as part of this review of the lending framework. So we will hopefully be publishing a consultation paper in Q4 this year, and we'd envisage that that consultation will be open for probably two months to 10 weeks, and we'd hope that that would close before the end of the year, at which point we'll then review all submissions received and finalise amendments for changes to the lending framework. Following that, we'll engage in a statutory consultation as required under Section 84A of the 1997 Act. This will involve consultation with the Minister for Finance, CUAC and the credit union representative bodies. Once this statutory consultation is concluded, we'll then publish a feedback statement with draft regulations, and we'd hope that this will be at some time in Q2. But obviously our timelines will be very much dependent on the level of submissions that we receive and the amount of time that it will take for us to review those submissions and consider a final approach. And we would hope that the commencement of the amending lending regulations will be towards the end of Q2 next year or early Q3. So before I finish up, I've just outlined on this slide a couple of useful resources that we published this year, which may be of assistance to credit unions or credit union boards who are considering engaging in either new types of lending or potentially increasing their exposure to longer-term lending. So in 2017, we undertook a thematic review on house loans across the sector, and we published the findings of that house loan review, both good practice and bad practice that we'd observed, in a thematic report that's available on our website. And in December 2017, we also published a longer-term lending guidance paper for credit unions, and this outlines the risks and considerations for credit unions and credit union boards to consider before engaging more in longer-term lending, particularly in house loans. So I've come to the end of my presentation now, and I hope that you've found it useful.